Welcome, everybody. My name is Joel Sinkin, and today we're going to spend the next 100 minutes very focused on a very specific issue, and that is succession planning and how to value your accounting firm, focusing on 2013 because of the significant amount of changes that have occurred in the M&A marketplace and public accounting over the last several years. I don't want to make this an infomercial for the company, but I think it's important to understand the background of the speaker. I'm the president of Transition Advisors. The only thing we do, I help accounting firms in ownership transition. We've been involved in, me personally, in over 950 closings of accounting firms over the last 24 years. So whether it's partnership agreements, mergers, acquisitions, excuse me, this is the only thing that we do. I happen to be the advisor to the AICPA on succession issues. I teach for the AICPA, most state societies. I've been published about 70, 80 times and have written some books on it. So enough about us, but the reason I take that moment to share this with you is so that you get a good feel that what we're really helping you to understand today are all the things that took over 2 decades to get to. So a lot of what we've learned is from watching people and us ourselves making mistakes and trying to help you avoid making the same mistake twice. On your screen, all you're seeing is some of our team. Again, I think there's enough of that. Basically, we're kind of all over the country and in Canada. So let's focus on the task at hand. And let me start by where I always start when teaching a CPE, and that is, if there's 50 things you need to think about when you're doing a succession plan, the smartest person in this room is going to think of 35. Today, we're not going to get you to 50. The reason we're not going to get you to all 50 things is because every practice is so unique. You could take 5 practices doing the same revenue with the same amount of owners, and I'll tell you that even if the metrics are the same, cultures are going to be different, relationships between the clients and the ownership's different. The uniqueness of every practice requires you to have, hey, here are the parameters we have to operate in, but we need the flexibility to understand the uniqueness of each situation we're going to be in. One of the things that I addressed a moment ago is how different things are. The economy in itself has had a huge thing to do with the changes in our M&A marketplace. You know, if you read the CPA Journal, the Journal of Accountancy, the Accounting Today, I happen to write for these publications, there isn't an issue that comes out that doesn't discuss mergers and acquisitions and succession planning. Matter of fact, in 2013, the AICPA's PCPS division, which is a division focused on 1 to 10 partner firms, their theme for the year is succession. So what's going on that's creating all this activity? Well, first, let's look a little bit of the changes in the economy. 2006, 7, and 8, most accounting firms were growing like a weed. The problem of the industry was staffing. Most people had the work to do. They didn't have the talent to get the work out the door. 2009, the end, the changes happened. 2012, all these question marks on your screen, and it's early to say, but in 2013, we're still hearing more problems about attrition. The top 100's new mantra, zero growth is our new growth. That we're having more issues with collections than we are in getting the work done and out. So this has had a big impact because when someone says, I've got 500,000, 5 million, or 50 million of repetitive business and I'm ready to give it up, there's a much greater audience listening when organic growth isn't as strong as it used to be. One of the other impacts is niche development, where we're doing a tremendous amount of cross-selling of additional services. You know, 25 years ago when I first started doing M&A of accounting work, there weren't CVAs and CFPs and all these zillions of 3 initials. There weren't people so focused on cross-selling and doing business valuations, litigation support, wealth management, you know, elder care. But these niche developments have come in. And as a result of that, we're seeing more merger activity where someone says, well, I deal with a lot of law firms, you do a lot of litigation support, we should merge. I deal with a lot of high net worth individuals, you do a great job with estate, trust, and wealth management, we should merged together. But the greatest impact, especially on succession, right now is the baby boomers. And this is something that's going to continue for the next 7 or so years. Just to give you an example of the impact on the demographics, in 1993, over 40% of the AICPA members were over 40 years old. And that over 40% was about 40.7%. In 2012, that number rose to over 70%. The 2012 AICPA MAP survey told us that 2/3 of the firms in this country that responded had at least one partner they expected to retire within the next 5 years, and more than 50% of the firms that had 4 partners or more felt they had at least 2 partners that would be slowing down. This is well up just from 2008. Scary, only 25% of the firms in the 2004 survey said that they had a written plan for succession. It jumped up to 35% in 2008 and only went to 38% in 2012. Jim Metzler, a wonderful professional at the AICPA in charge of small firm interests, very concerned about this issue of this lack of planning. And this goes on and on. By the way, this is information available to you. There is the MAP and the 2012 succession survey. Go take a look at the AICPA. They have it on their site. Phenomenal statistics, benchmarks for you to observe, things like that. So this is what's changing our marketplace. The amount of people and partners, especially founding partners, which represent 75% of the partners in this country, are the founding partners of their firms, are going to look to exit or at least reduce their time commitment at a time where we've also, over the prior 15 years, the worm turned a little bit 2-3 years ago, but for 15 consecutive years, we had the lowest amount of college graduates graduating with an accounting degree and the smallest percentage of them sitting for their CPA exam. So at a time we have our greatest exit, we have the lowest percentage of new people that came in that would normally be positioned to be part of your internal succession team. So at the end of the day, though, the good news for most people is if I'm looking for succession, there's still a market, because in accounting there's only 3 ways to grow. One is one client at a time. That's great in a good economy. In a bad economy, it treads water. The other way to grow is this new developing a marketable niche, so we have more services to penetrate our clients. But the only way to grow in any speed is to merge or acquire another firm. So one of the first places we need to go to when we're thinking about a succession plan is, when should we start the process? And before addressing that, let me start with a fundamental concept that a lot of what we're going to talk about today stems from. And here's what it is. I will say to you that probably 99% of your clients have no idea if you're a competent or incompetent accountant. I don't mean that in a negative way, but if they knew that much to measure your technical skills, why would they be paying you to do the work they understand so completely? Unless they need an audit done that, of course, they can't do for themselves, how do they have a yardstick to measure your skills? They don't. I hear it all the time. What a great accountant I have. You should see the refund I'm getting. Well, we all know that's not a measuring stick. Maybe they're going to go to jail if they get audited. Maybe the government shouldn't have your money all year interest-free. We all know that's not an answer. So why do you have your clients? The answer is because of you. It's a personal relationship. You're the most trusted business advisor of your client. They hope they are comfortable with you. They trust you. They can live with your fees. If they love your fees, raise them. They should just be able to live with your fees. But you have your clients because of you. Now, when I first started doing this, most of the small firms that I dealt with, the owner of the firm went out every month or quarter to each of their business clients. Heck, a lot of them did the work there, wrote their check, the client signed it before they left. But now we're in 2013. And in 2013, we have the cloud. We have email. We have the ability to go from our computer directly to our client's computer to pull information out. We have staff going out and picking up the work. So statistically, over 85% of your clients you're in the same room with once a year. I'm not suggesting you're not speaking to them by phone, on email with them. Our frequency of communication has increased, but our frequency of in-person client contact has dramatically decreased. And not just our annual business returns and personal returns, but our business clients. Again, and this is only going to get more challenging as the cloud takes on a larger role and as people continue to face time pressures. So the first question I pose, based on all these little premises I just started with, when someone needs to start to think about their succession and when they should start the process, is how many tax seasons do you want to work full-time? Full-time. Now, for some reason, a lot of people think I'm either working full-time or I'm retired. But there's a plethora of places between that. Most people I know end up preferring to gradually slow down. When they sell their practice, they look to stay on in a reduced role and still service the clients and hold the client's hands and generate new business. So the question isn't how many more years you want to work. You might want to work 20 more years. It's how many more tax seasons you want to work full-time. Now tie that into the second bullet point you have on your presentation, client FaceTime. If you are one of the more frequent types of accounting firms that are out there, that the majority of your clients you only see once a year, and someone says, hey Joel, I'm 4 years from slowing down, I've got plenty of time. I'm sorry, that's 4 visits, it's not 4 years. 2 years is 2 visits. See, if you have an unusual practice and you're still going out in person, meeting with your clients on a regular basis, the only tax returns you do are clients that are business clients that you're in front of all the time, you could transition a practice a lot less time. So the question becomes, how many more tax seasons do you want to work full time? 3 years is 3 visits. Now there are other things that could impact this type of thing. One thing that I'll address briefly now and bring up a little bit more later is, are your clients partner loyal or are they brand loyal? For example, traditionally, the smaller the firm, the more likely the client is partner loyal. If I'm one of the top 20 firms in the country, I probably believe my clients are brand loyal. If a partner retires, the clients are married to the firm, not a partner. But most practices have partner loyalty. This is another thing that increases the amount of time it takes to do a proper transition. So how many more tax seasons do I want to work full time? What kind of relationship do I have with my clients? Are they partner loyal or brand loyal? And do I see them? How often? These things will tell us when to start the process. In addition, there are things that come up, basically investments, that should spark a light that tells you maybe I shouldn't get involved in this investment because I'm closing in on my own succession. Let me give you a great example of that. Very recently, and I get this call all the time, I got a call from a firm that happened to be in Chicago. We have offices all over the country. And the gentleman I happened to be there, and he said to me, Joel, you know, we're a 2-partner firm. We're doing $1.5 million. I'd like to work 2 more years. My partner would like to work 3 more years full-time and then stay on part-time. And I've got great news. We just signed a 10-year extension on our location. We have well-appointed space, fabulous parking and access, and we got a below-market value. So I said to the gentleman, I said, John, let me ask you a question. You're a $1.5 million firm. What size firm do you think is your target audience to be your successor? And John said, Joel, probably 3 to 10 million, which, by the way, I agreed with, but there were other mitigating factors, but that's a second issue. So I asked him, a $3 to $10 million firm, John, don't you think they have an office? What he actually did with his partner by taking on an extension of their lease is they just dramatically limited their audience to be their successor firm by either people that happen to have a lease that just happens to be expiring, to people that would consider a satellite office, or most likely, People that are going to reduce the offer they make to that seller by the cost of carrying that additional overhead. If that successor firm was able to absorb them into their infrastructure, there would have been a lot of synergies. That means there would have been a lot more profit. That means not only would the successor firm have made more money, they could have been in a position to pay the seller more money and still win. But once I'm forcing them to take on certain overhead, I'm forcing them to keep my office manager. She's been with me 38 years. Yes, she makes $85,000 a year, and yes, she gets 16 weeks paid vacation, and yes, she doesn't have a computer on her desk, but she's very important to be retained. I get loyalty. But you have to think about it, certain types of must-haves. Must keep my location. Must keep all my staff. I have a firm in our Bethesda, Maryland office that 2 years ago realized, a little less than that they were so woefully behind in technology that the cost for them to get upgraded made more sense, since they were looking at their own succession in the near term, to merge with a firm who already was paperless, already had the multi-screens, already had the cloud, and basically would bring them into their system. And things are going to get worse. So you need to start planning these transitions and this succession in advance, because each year the amount of baby boomers that are going to start to reduce their time commitment to the firm is going to increase. And as a result of this, if the supply goes up, it's got to impact demand. Now, I often get asked, is it a buyer's or a seller's marketplace? I'll give you the short version of that. If you're a small firm in a densely populated part of the country, it probably always will be, a seller's marketplace. You know, when you say I've got 400,000 of repetitive business, and there's a lot of firms locally that could absorb that practice with no incremental increases in overhead, it's a real commodity. If I'm 30 miles west of Boise, Idaho, it may be some of the most beautiful country that we have, but there may be one accountant for every 2 or 3 zip codes. Therefore, the supply of successors is so limited, it badly impacts the marketplace. But what's interesting is who's probably in the most trouble, and it's probably the $3 to $10 million firm. They need to get going sooner than almost anybody. And the reason for that is, look at a town like Boston. Boston probably has 50 firms between 3 and 8 million in the greater metropolitan area. And they probably have 4 firms large enough to be their successor. And of those 50 firms, most of them probably think they have the talent on the bench to execute an internal succession plan, but the reality is they don't. And when they come to this realization, suddenly if there's only 4 or 5 successor firms and 20 looking for succession, who's going to be in control? Who's going to have the hammer? Let's talk about how to choose a successor. One of the first questions I always ask a firm that looks to be a successor firm is, what are you doing? What are you thinking about? What's your reasons for wanting to do this merger? Sometimes you hear great reasons. You know what? We've developed some really great staff. I want to promote them. I don't want to reduce my compensation to promote them. So by doing an acquisition, I could afford to bring them along. We have a lot of excess capacity. We have this, we have that. Those are great reasons. Here's a horrible reason. I have a lot of extra space. So I figured if I brought someone in, we could basically share overhead and I could spread things out. You know what? You spend more waking time with partners than you do your spouse. If the only reason your successor wants to do a merger is to reduce overhead, suggest they rent space to someone. That's not your successor. One of the things we don't think enough about when choosing a successor is their excess capacity. If I'm a 2-partner firm and each of us are putting in over 2,000 hours between chargeable and non-chargeable time, and both of us want to slow down over the next couple of years, do they have the capacity on a partner level to replace over 4,000 partner level hours? And maybe we have some staff that have aged with us. Do they have the excess capacity on a staffing basis to take us over? Do they have the space to take us on? Do they have the technology to do it? And you know, what about their financial strength? or malpractice or other issues. It shocks me to tell you that in over 20 years, I've never had a successor firm not do due diligence on the firm they were merging in or acquiring. But how rare it is the firm merging up or selling does any due diligence on the successor firm. If they're robbing from Peter to pay Paul, do you want to wake up one day being Peter? Do some homework. And one of the things that I always try and get everybody to remember is bigger is not always better. Better is better. I remember about 10 years ago having this terrible war story that someone shared with me at a CPE event I was teaching for the AICPA, where he had a small practice. He was a comp write-up tax, basically a real hand-holding practice. He was so nervous about transitioning into a small firm because he didn't think they would have the financial strength to make this work, and he felt more secure, and he went to a big firm. Well, his clients were used to dealing with a principal. You think the big firm was going to send a partner out to someone paying $400 a month doing a write-up? Do you think the big firm was going to operate under the same fee structure? Bigger is not always better. You have to find the right culture. You have to find a lot of other things. But we're going to talk at the end of our presentation today about the 4 big C's. That's how you're going to really choose the right successor. Some other things to think about is what specialties you have that they need to understand. I had a practice a couple of years ago that did SEC 17A broker-dealer work. And I had a client respond saying, hey, Joel, what's a focus report? Well, if you don't know what a focus report is, this isn't the practice you should be looking at. Right? Sometimes it could be a license. In the state of New Jersey, to do municipal accounting work, you must be an RMA, a registered municipalities accountant. It's the only state I'm aware of that has that regulation. If they don't have that license, they can't do it. Look at the size of the successor. Sometimes it's a proxy for culture, not always. Look at their retention rates. If they can't retain their clients, how are they going to retain yours? And capacity. We'll talk about billing rates in a moment when we talk about how to value a practice. A lot of people say, Joel, how important is location? My answer to them is a question. If your space, your lease currently was expiring and you weren't looking to slow down, you were working 20 more years, and you found beautiful space a little bit further away than you normally would have thought, great opportunity, great value, great everything, how far could you move that practice? As far as you could move that practice is as far as you could select a successor. And we'll talk about that when we talk about transitioning clients today. But one of the things that you also tell you a little bit about location are things such as, do my clients come to me? Do I go to them? Do they mail the work in? The less the clients come to your location, the less critical your location is to client retention. Maybe staff's different. Maybe comfort level of people is different. The more people that come to your office, the more important location is. Culture is one of the 4 C's I alluded to. We're going to spend more time on it later. But remember, if your clients are partner loyal, you need a firm that knows how to handle a partner loyal client. If your firms are brand loyal, same. Culture is made up of many different things, from rates to the way people are serviced, to are they billed on value billing, time and billing, flat retainers. All these things are part of culture. You need to find the cultures that make sense for who you are. A couple other things to think about, as I alluded to earlier: financial strength, professional strength. In this world of being politically correct, I think some people are forgetting that certain practices have some language and ethnicity. I have a firm owned by 3 women in Florida. They will only sell their practice to a firm that has significant amount of women partners. Why? Their whole marketing was to women-owned businesses working with women CPAs. I don't think it's inappropriate that they did it that way, but can they now turn around and sell it to a firm that's owned by all men? Something that isn't a breaker, but something you want to keep an eye on, is longevity of partners. If 2 people have never been partners before, they might know each other for 20 years. They may have worked together. If they've never been partners, they've never been partners. How do you know how they're going to react together? If there's an issue, do you want your firm in the middle of it? And if I'm selling to a staff person, their track record should speak volumes about choosing that successor. I think one of the most important things if you're doing a deal is to try and put yourself in the other firm's position. So right now, let me share with you the 4 big things that a lot of people that are considering a succession are thinking about. The first one is, I am irreplaceable. Tie that into, my clients need me. And while I'm a huge fan of loyalty, and matter of fact, as we'll discuss shortly, we've learned how to take advantage of loyalty, and the more loyalty that exists between a client and a firm, the easier it is to retain the clients, which I know is kind of counterintuitive, but we'll share with you how later in our presentation today. But the opposite is taking it to the extreme. I had someone the other day stand up at a CPE event I was teaching for an accounting organization, and they said, Joel, nobody can keep my clients if I'm not there. And I said, George, then your firm is worthless. If you're telling me nobody can keep the clients, why would I be the knucklehead who takes it on? Loyalty can be transitioned. A lot of people are very tied to their client base. It's a personal relationship. They're on second, third generation. They've seen them bar mitzvahed, baptized, and married. And they feel their clients need them for that reason as well, and they need their clients. If they retire, I'll die. I need something to do. But again, that goes to why you don't have to retire completely, stay on part-time. But one of the greatest obstacles, especially for smaller firms, is I am master of my own domain. Right now, if I own my firm and it's Tuesday and I'm on top of my game and the weather's nice and I want to play golf, I play golf. If it's Sunday and work has to be done, I do the work. The idea of merging into a successor firm to help orchestrate my eventual exit is scary, because right now I am master of my own domain. I am the boss. I don't want the accountability of being someone's clock-punching employee. I'm the person that runs, that makes these decisions. I run what I want through my business entity. I take as aggressive of a tax path as I want on my expenses. These are the things a lot of sellers are thinking. If you want to do a deal with them, respect it. This is not something I'm making fun of. I have great respect for this. And there's ways to treat all this and overcome all of this if you want to make a successful deal. Whenever I talk about how to value an accounting firm, there's always 3 big questions people that attend come to me with. The first one is, what's the multiple? The second one is, what's the multiple? The third one is, of course, what's the multiple? But we need to get our arms around some things before we tell you, and we will tell you, what is the multiple. The first thing is, how are most purchase price structured? On an external sale, most firms are sold on a multiple of gross billings. If someone says they got 1 time, they're expecting to get a purchase price of 1 time their gross revenues. On internal sales, they could be a multiple of your ownership times billings. They could be a multiple of compensation. Many of them on internal sales could be a fixed purchase price, fixed again as compensation or of equity. So when we talk about multiple, though, for the most part, we're going to be talking about multiple of gross billings. But before we talk about how to value that firm, let's talk about how most deals get structured. And I'm going to break it down into 5 different categories for you. The first one, let's call the straight sale. Now, what I don't want this to sound like, I'm selling my practice and I'm going to Boca Raton tomorrow to work on my handicap. What I mean by a straight sale is I am no longer working full-time. I am not looking to stay on as anybody's partner, and I'm transitioning my practice day 1. Maybe I'm going to work 5 more years part-time, but I'm certainly, hopefully, going to be available to do a proper transition. So a straight sale. It's probably the least, well, not the absolute least, but not the most often we do, because most of them have a longer transitional period. A buy-in to buy-out is also the minority of deals we do, but it's an interesting one. Let me give you an example. Let's say that I have a $800,000 practice, and Jeff has a $200,000 practice. Well, the combined firm is $1 million. For For Jeff to be a 50% equity owner in my firm, he has to have 500,000, but he only had 200. So he acquires $300,000 worth of equity day one, and maybe 3 years later, buys out the balance. A buy-in to a buy-out. Most of the time, the firm doing the buy-in to buy-out, who obviously is going to be the long-term successor, will apply their practice as part of the purchase price to do the buy-in. I've had some sellers say, you know what, I don't want the liability and exposure or headache of your firm. You could buy in an equity interest into mine and buy it out, and you could keep your clients separate. But those are the two main types of buy-ins to buy-out. A merger to a buyout is the same thing as a buy-in to buy-out, but no buy-in. So in the example we just gave, in a very simple way, where I said I was 800,000, Jeff is 200,000, we merged together, and I guess Jeff's a 20% equity partner, and 3 years later when I leave, he buys out the 80% equity interest. So a merger to a buyout is very similar to a buy-in to a buyout, except there's no initial acquisition. An interesting new thing I'm seeing more and more of, again, still the minority of deals, but I see more of them, is what I call a cull-out or a carve-out sale. Let me give you a couple different examples of them. Very recently, just this past year in Manhattan, we had a firm. They were a real good firm. The owner of it had a great niche in wealth management. Loved doing the wealth management and considered himself quite good at it. Hated doing the traditional compliance of accounting work. But he continued to do the accounting work because he felt that the accounting work was the leapfrog that got him to the wealth management. And he had a big firm. He was doing almost $2 million as a sole practitioner. What we ended up doing for him was we ended up introducing him to a firm that was filled with high net worth individuals, by the way, but they did not do any wealth management. That firm bought this gentleman's practice. And the way the deal worked was as follows. The gentleman who sold his practice signed a non-compete as it related to compliance work, traditional accounting compliance work. The buyer of that firm signed a non-compete as it related to wealth management. They held it out to the client base as a merger. The seller, in a letter to the client, said, hey, it's impossible to stay on top of the day-to-day changes in the Obama tax laws, the complexity, and the day-to-day changes in the stock market and the value and all your wealth management needs. So in order to service you better, I'm merging with John and Jane Doe. They're going to help me by focusing more on the compliance to free me up to focus more on the wealth management. Held it out as the age of specialization. They even constructed a deal where the successor firm opened up access to the seller to provide wealth management with a sharing, because they were both licensed and able to legally share. So what we created was a situation that they're actually even sharing space together right now. So to the world, it looks like a merger, but in reality, this gentleman did a cull-out sale. I had someone that was making a ton of money doing litigation support and business valuation and gave up the traditional monthly, quarterly work that they had. But another type of cull-out sale we're seeing a lot of is, for example, just a little while ago in our Texas office, we had a gentleman, again, it was a smaller deal. We've done some of the biggest deals in the country, but this was a small deal, about an $800,000 practice. The gentleman took out $125,000 of his favorite clients, not his best paying, his favorite clients. He sold to the successor firm the rest of his firm, moved in with the successor firm who gave him free overhead, free use of their infrastructure, and other than any incremental increases, because he could be there to transition the relationships. But he retained enough clients that he felt good, kept him busy. And in reality, it didn't even impact his income, because when you added the purchase price he got from selling the $675,000 of his practice, plus the $125,000 that he kept, his gross was basically his net. He was basically working 4 or 5 days a month, other than during tax season, making similar money. A cull-out sale. But by far and away, the most frequent deal that we do is called the two-stage deal. One of the handouts we provided you today is an article on the two-stage deal, and I encourage you to read it. On our website's also a couple of 2 different white papers on case studies of that. But let me give you the genesis and explain a two-stage deal to you. The genesis is, for 20 years I was going around talking to the accounting industry about why do you have your clients? It's because of you. It takes time to transition the relationships. 3 years is 3 visits. And everybody was, yes, Joel, and nobody did the deal. Why did nobody do the deal? What we talked about before, master of your own domain. They didn't want to give up control, autonomy, income, being their own boss. So out of years of frustration, we created the 2-stage deal. I'm going to walk you through an example of a small deal that we closed in California just a few weeks ago. That was a classic 2-stage deal. It was owned by a sole practitioner doing about $600,000 in revenues. He was making that let's say $500,000. He was making that based on having 1 manager, 1 junior, and 1 paraprofessional. He was netting, including perks, benefits, and probably his kid's cell phone, 40% of what came in. He wanted to work 3 more years full-time, and then who knew how many years part-time. The ultimate deal we struck for him was a 2-stage deal. The successor firm said to him, Mike, right now you're making 40% of what comes in. You come in, work with us. We're going to take over all of your operating expenses, and we're going to pay your entity 40% of what we collect, which is what you're making now. And because we're going to pay it to your entity, you can continue to have your entity pay your car lease and your medical insurance and your kid's cell phone and anything you want without having to clear it by us. And we said, Mike, you can come and go as you see fit. You're not our clock punching person. So Mike, all of a sudden, was put in a position to have backup support, guaranteed succession, making the same money, same control. So how does it work? Well, there's only 2 ways Mike could make less money. Way number 1 is as the fees go down. But as I shared with Mike, his largest client was a $50,000 a year manufacturer. I said, Mike, if you don't do this deal and lose that client, how does it impact you? He wasn't sure where I was going, so my answer to him was, you lose $50,000 of net. All the rest of his expenses were fixed. He couldn't fire anybody. He couldn't shrink his lease. Now, if he lost that client, he'd only lose 40%. The other way he could make less money is if he suddenly needed more labor than he used in the past. As I mentioned, he had 3 staff people in varying roles. The successor firm said to him, hey, we're going to give you the same amount of staff support you had in the past, but if you need more labor than that, we're going to charge you 2/3 of the billing rate for the excess, based on 1/3 labor, 1/3 overhead, 1/3 profit. But why would he need more labor? The only way he would is if he chose to slow down. So basically, he still comes and goes as he sees fit. He makes the same money. He's in control. He's in charge of his clients. Nobody's going to keep him whole in income and do all the work for him. He still has to run his firm. The successor firm, because it's held out as a merger, takes over all the admin day one because they want the clients billed under the new name. They want it all looking like a merger. So in a way, a lot of the stuff that Mike hated, the billings, the collections, overseeing the payroll, will all removed from him. And he had now additional time to either devote to transition, quality of life, or maybe bring in new clients. Why did the successor firm do it? Well, the successor firm had no incremental increases in overhead. They kept the senior. They didn't need the junior or the para because they had the excess capacity. So between rent, software, and the labor savings, they put over $150,000 in their pocket during those 3 years. By the way, a week or 2 before closing, Mike calls me up and says, hey, you know what, Joel, they're making $150,000 in overhead. I should get some of that. And I kind of beat him up a little. I said, no, you shouldn't. Mike, you got everything you wanted. Backup, support, succession, control. The fact they're getting a benefit's why they're doing the deal. Don't forget, they got to meet your clients. They got to take over all the billing. They don't get the real benefit of the firm until you slow down. If they have no reward, what's their motivation to do it? Everybody wins. Now, stage 1 terminates on the first of the following events. In this particular deal, 3 years later, God forbid a health issue came up with the seller, or the seller, not the buyer, has the right to accelerate by giving them 90 days notice if he just decided to get out sooner, other than, of course, during tax season. Stage 2 is the buyout. 100% of the buyouts deferred in a 2-stage deal because I can't keep you whole in income and pay you for your practice at the same time. And if you put me in a position of trying to do that, I'm going to pay you less than your practice is worth and less than your time's worth, because I'm not going to do a deal to lose money. Therefore, by deferring one for the other, Mike got the best of both worlds. Maintain income control, backup support, has a built-in practice continuation agreement because God forbid something happened to him and accelerated to the buyout. His buyout still has a retention element. So by doing this tremendous transition, retention is going to be maximized. Therefore, not only do the clients keep and make more money, but they pay the seller more money because they kept the clients. Again, everybody wins. Now, once you own and understand a two-stage deal, you could take the implications in many other places. In our Chicago office very recently, we had a 4-partner firm that we merged into a regional firm. One of the partners was looking for an immediate sale. One of the partners wanted to work 3 more years and then slow down. 2 of the partners, there were 4 partners, excuse me. 2 of the partners were only in their early 40s and wanted to work 20, 30 more years. So what happened? With one successor firm, we did 3 deals. The gentleman looking to get out right away got a 2-stage deal. The woman that wanted to stay on 3 years got a 2-stage deal. Instead of the first one got a straight sale, excuse me. The second one got a 2-stage deal. And the remaining 2 basically exchanged their equity in their original firm for equity in the successor firm. So for them, it's a merger. This is why the bulk of the deals we do involve a 2-stage deal. But what this enables people to do is when you have multiple partners in different places, some seeking to slow down, some people looking to grow, but the ones looking to grow lack the capacity, professionally, financially, time, whatever, to absorb and take over for all the people that are looking for succession, enables us to bring them into one firm and cut individual deals for each one. So these are the 5 main ways of succession planning with an external firm. Remember, this isn't an internal sale. We're going to talk a little bit about that, on how to structure them. So that brings us to how do we value a practice? If you're one of the 30 people that bought the book I wrote about 18 years ago for PPC on buying emerging accounting firms, first, thank you. And second of all, don't hate me because I know in the book I said there were 11 variables on how to value a practice, and today I'm saying there are 5. Well, when I did the book, I was paid by the page, so I'm a bad man. Let's talk about the 5 variables I look at when valuing an accounting firm. The first one, in no particular order, is cash up front, if any. And let me share with you that I have never done a deal, and I've been involved, as I said, in over 900 transactions where someone just wrote someone a big fat check and bought their practice. I know that there's messages out there being told to people that we can get you all cash for your practice. You can get it, take it. It's a very rare situation in the real world of accounting. Cash up front, I will give you a benchmark. In the deals we've done, I can't give you benchmarks in the deals we haven't done. The cash up front has ranged from 0 to 20% of the revenue or the anticipated purchase price, with more of them at 0 than at 20, and most of them somewhere in the middle, like around 10%. But money up front isn't just dependent on the depth of my pocketbook. For example, time of year has a big effect. If I have a practice that I generate 70% of my annual revenues during tax season, and I'm looking to close a deal June 1, well, heck, the successor firm might actually operate that practice almost at a cash flow loss at some point in time, if that much of the revenue was already billed. It's very hard to give someone a practice when they're going to be months away from profit and also ask for a lot of cash up front. What a lot of people don't tie in together also is the treatment of accounts receivable. If your accounts receivable reminds someone of Charlie Manson, and you're months and months and months behind, and you say to the buyer, hey, the first dollars that come in have to go to my old debt, and that buyer is going to be working 3 to 6 months on each client before they start collecting money, you think you're going to be able to get a big down payment on top of that? That probably is your down payment. So how we treat AR and WIP, how quickly the cash flow is coming in, which ties into how I can recover that investment. If I'm going to buy a practice in January that produces 70% of the revenue in February, March, and April, I'm not as afraid to put more up front than in June. If I'm doing it in June, but everybody pays monthly retainers right away and I'm going to be in cash flow right away, I may not be as concerned if there's an AR issue. So cash up front has an impact. And forgive me that it says 2012. Here it is February. I'm still having trouble typing the 3 instead of the 2. But there's also a big economic impact when it comes to cash up front. We've seen it drop heavily the last few years. Why? Accounts receivable is slower. So successive firms have less positive cash flow. Lines of credit are harder to get. Loans are harder to get. So cash up front is our first variable, and we have seen some impact. The second variable is the duration of the retention period. Some people call it a guarantee period. Never been comfortable with the guarantee. You know, the 13th Amendment prevents slavery. You can't buy and sell people. So I always look at it as a retention period. And what we're referring to there is how long after the deal closes does the loss of clients or the client's fees going up impact the balance due the seller by the buyer, excuse me. So let me give you some examples of retention periods or guarantee periods. The first one we'll talk about is a collection deal, a deal by percentage. Some will refer to it as an earn-out deal. And let me be specific. Let's use a simple example. I'm paying somebody one-time multiple over 5 years on collections, then I'm paying 20% of collections. If I'm paying them 1 1/4 over 5 years, I'm paying them 25% of collections. That's a collection deal. Now, a collection deal, basically, for the most part, a buyer says to the seller, I'm going to kind of open up a separate bank account or track these clients on Exhibit A of the contract, your original clients. And every month, whatever I collect from them, I'm going to give you your percentage during this billing period. By the way, remember, it's a billing period, shouldn't be a payout period. Meaning, if I use the example, 20% of collections for 5 years, it should be a 5-year billing period when collected. If you do work in month 59 that you bill in 60, that you don't collect in 63, it should still be the seller's money. It's a billing period when collected, right? But at any rate, so shockingly to a lot of you, I will tell you that 80% or more of the deals that we've been involved in on external sales have been a collection-oriented deal. And we're going to come back to that in a minute. A deal that we have never done, but is out there on a rare occasion, is a fixed deal, meaning day one, a price is set. Doesn't mean the check was written day one, but there's a fixed guarantee deal. Very, 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 very rare. Internal deals, not so rare. External deals, very rare. The third type that I'm listing there is a limited guarantee or a limited retention period. That might be where the seller says to you, hey, whatever you do in the first 2 years locks my purchase price. If you lose them after that, look in the mirror. So I'm going to give you a 2-year guarantee or retention period, but we're using the example, it's an example only of a 5-year payout, but the last 3 years payments are fixed. So let me tell you something that I think is very, again, counterintuitive, and that is, what deal of those 3, before we talk about the economy clause, has been the most effective deal for the buyer, the least effective for the seller, and the most effective for the seller? So as a seller, I would have said to myself, if I didn't do the homework, and I've reviewed over 100 deals for a white paper I'm preparing on this very subject. I reviewed 100 deals. The worst deal was the deal I would have thought most sellers would have thought to be the best deal, and that being a 1-year guarantee deal. Meaning, whatever the buyer did in the first year locks the purchase price. Let me tell you why, looking back at the deals that were closed, that turned out to be the worst deal for the seller. First of all, one of the problems that you have when you're selling an accounting firm is your buyer. Your buyer's an accountant. We're trained skeptics. We're trained to look at something and say what's wrong with it. See, what you didn't know was in your cushions and your seats when you sat for your CPA exam was a special chemical that comes up into your body and makes you that way. We always look at everything and say what's wrong with it. So when a seller says to a buyer, whatever you do in the first year locks your purchase price, what are you thinking? You're thinking, why doesn't this seller have any confidence in the client retention? What's going on in this practice? And they envision Moses opening the Red Sea and parting it and taking all the clients away in month 13. So what does an accounting firm do when they're told it's a one-year guarantee? First thing they do is they reduce the offer they would have made because they impute this greater risk factor. Second thing they do, if they're good business people, is they shake the tree real hard during that year. You don't want to lose a leaf off the tree in month 13 that you could have lost in month 5. So you tend to be very, very quick to make your changes and make it clear what's going on here so you can shake out who you're going to shake out. So if I'm going to be that aggressive in the transition, what year am I going to have the greatest loss of clients? Year 1. I'm getting the lowest multiple the market will bear, locked in at the lowest point in time of the revenues of the firm. It has not been a home run for the seller. Interesting again, on external sales, one of the best deals for the buyer was a 2-year retention period. And remember, by the way, in a 2-stage deal, the retention period doesn't commence till stage 2. It doesn't start during stage 1. For those who are trying to put that together, I apologize, I didn't bring that up before. But let me tell you why the 2-year limited retention period worked so well for the successor firm. Here's my theory. If I acquire your practice right now, and I do the work in 2013, and they come back in 2014, they're mine. What's the likelihood of me losing them in years 3, 4, 5, and 6? Probably not that much. What's more likely is fee increases, special projects, all these other positive things that are going to come from this situation. So what happens frequently is, by year 2, we've shaken out who we're going to lose, and who we have, they're still ours. Right? The true measure of retention in most deals is the second year after the seller's no longer chief cook and bottle wash. And so that deal has worked very well for the buyer, other than the 10,000-pound gorilla client. Meaning, let's say I had a practice and one client made up 25% of the revenues. Well, probably that client I'd want a longer retention period than 2 years. If all the other clients were within the same grasp of each other in revenue, I probably would be more comfortable having a limited 2-year retention period on them. But again, an oxymoron, the best deal by far, according to the research we've been doing for the seller, has been a collection deal. And let me tell you why. Here it is, the seller taking on all this risk, which ties into choosing the right successor, which again, we're going to talk about. But what happens when you take the risk? By removing it off the successor firm, they're willing to pay a premium. So maybe instead of paying 0.75, I'm paying 1 time, or maybe instead of 1, I'm paying 1 1/4, because I don't feel that as risk. Also, instead of me shaking that tree to lose leaves as soon as possible, I'm very patient in the transition. I don't have to institute my changes right away. I have time to transition these clients to mine because I'm not at risk. And what's more likely? The client that came back in year 2, again, fee increases, growth, and most of the time, certainly if I'm involved in a collection deal, the seller's going to participate in that growth. It's very hard to say, hey, Mr. Seller, Miss Seller, if I lose this client, I'm not going to pay for it. By the way, if the fee goes up, you're not going to get that either. A good deal's a fair deal. They're going to participate on the downside. They bloody well should participate on the upside. So historically, the collection deal has given the seller a higher valuation, and by the end of the payout period, a higher purchase price than the fixed or limited retention deals. I have an economy clause just to give you a brief what that is. It's something that's really come up since 2012 and now in 13 and even 10 and 11 when the economy took this downhill. A lot of people got nervous. I'm buying this practice. What if the client goes out of business, dies, relocates? I don't want to pay for the client that I never really got my money back on. So sometimes when you have a limited retention deal, like a 2-year retention deal, the buyer might say to the seller, hey, okay, I'll go with the 2-year retention deal. And if I lose a client in year 3 to another local accountant, my bad. But if I lose that client, because that client no longer needs the services of an accountant, they went out of business, they died, they relocated, they sold, you'd have lost them too. And I'd like a limited adjustment for that 1 extra year, an economy clause. So variable number 1, cash up front if any. Variable number 2, the duration of the retention period that adjusts the purchase price. I'd say the least understood variable is the profitability. And let me share with you why I say that. As accountants, we value businesses all the time. And how do we value a business for a client? We base that value on the seller's profitability. Everything is derived from the seller's profitability. For me, I barely look at the seller's profitability as anything beyond a starting point. And let me give you a simple example of why I tend to ignore the seller's profitability and focus on what the buyer's anticipated profitability is going to be. Let's use a very small example. Let's say it's a $300,000 practice and I owned it. And 5 years ago, I ran it out of my home. My wife, Kathy, was my assistant. She answered the phone, did some inputting. What was my net? 85% maybe? And then you know what happened? We were tired of people knocking on our door, so I took an office. Kathy didn't want to come with me, so I hired a paraprofessional to help me. And I fell in love with golf. I hate to admit it, I'm a golfer. And I hired a per diem person to come in so that on Tuesdays I could take off and play golf. And now my net's 40%. At what point in time was my practice worth more to you? It's irrelevant. It's absolutely irrelevant. You see, the profitability of the deal is what matters to you. Again, if you could absorb my practice with no incremental increases in overhead, it's an amazingly profitable acquisition. If I ask you to take on this space and I ask you to take on this staff, and it's less profitable. If I have to take on more overhead, it's less profitable. So what you need to do is stop focusing on the seller's net and convert that to what your net's going to be. And the same theory applies to billing rates. One of the articles we supplied you with today is called The Great Mystery of Billing Rates. Right? And let me give you another great example of where I'm going with the mystery of billing rates. A couple of years ago, I had a 2-partner firm doing a couple $1 million down in, I think it was in the Philadelphia office. And they had a very unusual firm. Number one was also unusual, was both partners were seeking succession in a relatively short period of time. They had no managers, no seniors. They did all the high-end work, and they had juniors and paras that knocked off everything else. Well, it was a small regional firm was going to be their successor, and during the due diligence process, they called me up and said, Joel, we just realized we have what's probably a breaking issue that we've discovered that we should have seen day one, and it's our fault we didn't. I said, what is it? And Elliot said to me, their partner billing rate's $200 an hour. In our firm, partner billing rates range from $300 to $350. So I said, Elliot, let me ask you a question. When you absorb this practice into your infrastructure, not who's doing the client contact, who's going to do the work that these two partners were doing? They didn't have managers and seniors. So in your firm where you have managers, seniors, juniors, all these different levels, give me an idea, you're doing due diligence, who's going to pick up the pencil and perform most of that work? And he very quickly said, well, one of the things we realized is 90% of the work they're doing we would have done on a senior level in our firm. I said, what's your senior billing rate? He said, 1.25 to 150. I said, well, I guess they're getting 200 now. See, what he forgot was, again, he was looking at a piece of paper and marrying himself to some sort of billing rate. We're an accounting firm. We have to go in our due diligence and say, okay, what time and effort will it take us based on our peer review requirements, our technology, our staff to get this work done? Most of the time, the successor firm's actually more efficient, has more layers, more leverage to push work down. Doesn't always work that way. Had a due diligence done about 8-9 years ago on a pretty large deal. It was a $9 million firm going into a 40-some-odd million dollar firm. They only did 10% of their volume was audit. But what we discovered in due diligence was they had one partner that handled each audit from beginning to end. The successor firm said, I need 2 pair of eyes for my quality control process on every one of those audits. It's going to take us about 50% more time to get that work done. And when we realized we couldn't raise the fees that much, we had to walk away from the audit side of that practice, which ended up killing the whole deal, by the way, because they didn't want to portion it, have one buyer do this and one buyer do that. But the point is, you can't look at their billing rates and come to a conclusion. You have to transpose their billing rates into your firm. And if you see what work's being done, you should have a good idea of who you would use for it. One of the other things that affects profitability that not enough people think about are the tax ramifications of the deal. Hey, I get it. I know why if I'm a seller, I want goodwill. We all understand that. But let's say I'm getting a 4-year payout, but the buyer has to deduct it over 15 years. Do you think you're going to get the same value for your firm structured in a way that gives you goodwill compared to what would happen if you structured the majority or all of it in a manner that gave the firm a current deduction? Here's a great example. We had deals that have been done where a lot of it was allocated to consulting, and that money was paid to the seller's entity because it was a consulting compensation. Their entity continued to pay their car lease and their medical insurance and their IRA. Yes, what came out was taxed at a higher rate, but they had the use of pre-tax dollars, and they got a higher value than they would have if they would have insisted on all goodwill. And you cannot make an offer unless you include in the offer what the tax ramifications are going to be. Happens to me all the time. We do a voluminous amount of consulting work on deals where people have already met each other, and they'll call me up and say, Joel, everything is done. We've worked out all the details. We just really need someone to draft the agreement and help us plan a transition. And I'll go through the terms and I'll say, by the way, what's the tax treatment? And the seller will be saying goodwill as the buyer is saying the current deduction. You don't have a deal until you've included all that. The fourth variable in our 5 variables is the most simple one. It's the duration of the payout period. Excuse me. I will give you our benchmarks. For firms under, let's say under 2 million, under $1.5 million, 2 million, most of our payout periods fall between 3 and 7 years. Many more at 7 than at 3. 3 is a very rare thing. Most of our small deals, the payout periods, 5 years is probably the most typical. When you get into larger revenues, payout periods are usually much longer. You know, a $10 million firm, a $30 million firm, you're looking at a payout period more likely between 7 and 12 years, with most of them being 8, 9, or 10. So the larger the revenue, the longer the payout period. So here we have our first 4 variables in how to value an accounting firm. Cash up front, if any. The duration of the retention period that adjusts the balance due based on client retention. The profitability of the deal for the successor firm. And the duration of the payout period. Once you have those 4, you have the multiple. You see, the multiple is the effect. Those first 4 variables are the cause. You can't start with multiple. You have to end with multiple. Think of this formula. The less money up front, the longer the payout period, the longer the retention period, the more profitable the deal is as it's structured and can be, the higher the multiple. Ask someone to pay you faster, more money up front, shorter retention periods, goodwill, keep my office, the multiple goes down. Let's take an example to show you how powerful these 5 variables combining can be in valuing your firm. And let's use the simplest of example. Let's go back to me owning a $300,000 accounting firm. And let's say all of you taking this class today could absorb this practice with no incremental increases in overhead. You have the space, you have the staff, you have everything you need to do the deal. I can't imagine a more profitable acquisition. So now let's say as a seller, I said to you, I'll tell you what, pay me 17.5% of gross collections for the next 10 years, structured as a consulting agreement with no cash down. As a buyer, would you do that deal? See, most of the time I ask that question and the buyers say to me, Joel, I'd never pay 1 3/4 for a practice. See, I don't see it that way. The way I see it is, if in the first 2 years I raised the fees 8.5% or 8 3/4%, I paid for the entire acquisition. If after 5 years I lost a client, I've already collected 500% and I haven't even paid 100%. I had no risk, I had current deduction. I might have to think about that type of deal, which is granted an exaggeration at a 1 3/4 multiple. It's probably been 10 years since I've seen anything like that. But I'm trying to put a case together here for you. Now, I changed my mind. I say, you know what? I want to be paid out over 5 years. And whatever you do in the second year locks the purchase price. And I want 10% up front, but I'm still going to give you a current deduction. Now, depending on where you are in the country, you're probably looking at a range of 0.75 to 1 1/4. Most of them will be between 1 and 1 1/4 in most places. Now the same seller, me, says to you, hey, I want to be paid out in 3 years. And whatever you do in the first year locks my purchase price. And I want this to be a goodwill transaction, and I want 20% up front. I don't think I could get them 0.7 or 0.75 anywhere in this country. Same seller, me, says, ladies, gentlemen, I want all cash at closing. I know transition advisors couldn't get you 50 cents on the dollar. So in one extreme example, I'm saying I got buyers that would run to the altar and pay 1 3/4, and I don't have one buyer that would pay 0.5. Multiples the effect. You have to look at the cause. And now some of you might say, well, Joel, when you use that 10-year payout, you're forgetting about a critical thing, and that's present value. I'm not forgetting about it. I'm ignoring it. I'm ignoring it for 2 reasons. Number one, I'm horrible at present value. I get the concept. I don't know why I had trouble putting it together, but I'm horrible at it. But that's not the main reason that I ignore it. I ignore it because it's irrelevant. See, present value is based on an interest factor, as we all know. If I'm paying someone 15% for argument's sake of collections for 10 years, and the fees go up, I'm paying them on that increase. Therefore, since there's a high likelihood, based on our history of having good client retention and everything else, that the fees are going to go up, it's better than the interest factor. So present value doesn't apply. What makes this deal work on that long payout was no risk or reward. So these are the 5 variables that come together to create purchase price. Now, I have a last bullet on this before we move forward a little bit, and it says tax clients versus traditional accounting clients. Let me tell you why I put that there. The most frequent question I was getting asked a couple years ago before I started adding it into my presentation was, well, Joel, isn't a tax client worth less than a business client? And I'd ask everybody who brought that up why they felt that way. And they gave me 2 reasons. The first one is, it comes at a horrible time of year. And my answer to them was, get over it, you chose to be an accountant, next. The other reason was a valid reason. They said, you know, we have a higher attrition factor in our 1040 portion of our business than our business clients. That's a legitimate concern. But then I asked 3 quick questions. And I said, on a pure profitability, blended billing rate, whatever, what do you make more money, business client or the tax return client? Most people said the tax return client. On a pure collection basis, what do you make more money on? What do you collect easier? They said the tax clients. On an exposure basis, liability, what do you have more on? They said on the business client, not the tax client. I said, but you want to pay less. Their one legitimate reason is retention. That's why where this comes into play, tax versus business clients, is in the retention period. See, if I'm paying someone, for argument's sake, 20% of collections for 5 years, if I lose a client, I stop paying for it. Therefore, I cannot devalue the practice because it's 1040s, not business clients. Conversely, if a seller says, whatever you do in the first year locks the purchase price, and these are all 1040 clients, and I'm going to have one visit doesn't constitute loyalty, it's going to have a major impact in my valuation. So tax clients, or any type of annual clients, versus more monthly, quarterly oriented clients, are really a retention issue. And through being a retention issue, it can become a value issue. So let's move forward a little bit on a couple other things to consider whenever getting involved in a merger or acquisition. Let me start with something that, unfortunately, I think most of you will find to be a pretty big negative, and that is the question about furniture, fixtures, and equipment. I get asked a lot, hey, what about my computers and my servers and my desks and my chair? My answer is, don't ever ask me again, it's worthless. Okay? 99% of the time, it's worthless. Right? I already have a computer, I already have a copy machine, I already have desks, I'm not looking for yours. Now, believe it or not, the large deals will tend to value hard assets. Smaller deals tend not to. And there is times where you're keeping something as a satellite office where there will be a value. So I'm a little extreme when I say forget about it, but most of the time, there is no value in it. Keep what you want to keep, give away what you want to give. If you ask for a value for it, they'll simply reduce the offer they make on the practice. So it's a wash. Other things you really need to focus on are things like leases and location and the new staff joining the firm. These can be assets, they could be detriments. If there's all the clients have if a lot of the clients have significant client contact with certain staff that aren't coming, that could be a negative. If some of the staff is really good, really talented, they're young, they're just not ready to take over a firm, that might add value to it. So these things will have some impact in the valuation. An interesting question becomes, when it relates to the retention period, what will the seller participate in? Meaning, what about fee increases from prior services? I'll tell you, in every deal I've ever done during the retention period, or not every deal, the majority of them, forgive me, fee increases from prior services will count towards the purchase price. Some firms will want to say, hey, listen, you don't do audits, I'm doing the audits, therefore it's a new service, you shouldn't participate in it. It's a tough way to negotiate. I'll tell you that happens very rarely, because then the seller sits there and says, but if you lose this client, I'm participating in it. And by the way, a result a lot of people say to themselves is, then I want to put in a cap where you can't participate in the growth more than X. Whenever you come up with a cap, a smart seller is going to come out with a minimum. Let your problem be you're paying the seller more money than you ever thought you would. That means you're making more money. It's a good problem. It's not even a problem. So some firms will negotiate, though, what the seller participates in. A frequent negotiation I'll see is maybe the seller will participate in fee increases from new services that the seller never rendered before, but maybe to the degree of an offset of lost clients, or maybe to a degree of a lower percentage than they were getting paid on the traditional services. One thing that's very rare is fee increases from referrals, meaning if I acquire your client base and 2 years later someone on your client base refers me a brand new client, that's usually the fruit of the buyer's labor. Number one, it's terribly difficult to manage and police. But that's part of what we're paying a premium for. We understand when we buy a practice, we're getting a referral base. If after years of doing a good job, I'm getting a referral, it's very rare that the seller will participate in that. However, one of the things I'm a huge fan of is giving every seller a new business incentive clause. Even if they haven't grown their own firm in the last couple of years, remember, most sellers are looking to work less, not more. But if they're no longer working full-time, but they still have their relationships of decades in a community, and they are given a good new business incentive where they get a percentage of the fees generated from the new clients they bring into your firm that your firm accepts, some of these people could be great rainmakers for you. It's always worth considering. We've spent the entire dialogue thus far on external sales. But many of you might be saying to yourself, my goal is to sell my firm to a partner, maybe to a family member inside, maybe to a staff person. So while the majority of small firms are done on external sales, the majority of large firms do an internal sale. So I want to take a little bit of time and that we have left, part of it, to focus on the differences between an internal sale versus an external sale. Let me start with one general concept that a lot of people find a little bit disquieting, and that is an internal sale almost always goes for less than an external sale. I very rarely have my partner pay me the same, let alone more, than what I'm getting from a stranger. And there's a lot of reasons for that, but one of the biggest reasons is sweat equity and the fact that we grew this together. Maybe Joan and I are partners, and when Joan first came in, I was doing $1 million, and now we're doing $1.8 million. Isn't she part of the reason that we went from $1 million to $1.8 million? So most of the time, an inside deal goes for less. What I find disturbing personally is how many of them go with no retention period, which I'm going to tie into no notice period as well. But let me explain what I mean about no retention period. For most of you, I'm sure it's obvious. That meaning when I retire, I'm getting a some certain amount. It's probably not all cash, it's probably a payout period, but a some certain amount. Now, if my practice, my clients are brand loyal, I kind of get the idea of no retention period. You know, we've fostered these clients, they're not loyal to Joel, they're loyal to transition advisors, therefore there's a value that we don't have to worry about retention relating to. But if your practice is partner loyal, and each of us manage our own books of business, and other than a name on our letterhead, my clients don't know you and your clients don't know me, and there's no retention period, I find that very disturbing. Now, there's ways to handle that. One of the ways I'm a big fan of handling that is a requirement of notification. Almost every partnership agreement we prepare, we suggest a minimum, preferably 3 or 4 years, but a minimum of a 2-year notification period before someone can retire. And language in that partnership agreement that specifies what you need to do during those 2 years, which is basically transitioning clients. If I expect to make the same money, I might even have to increase my chargeable time because I'm going to have more time to do that because I'm going to have less client time. Some people will require during those 2 years you gradually reduce your compensation because we're reducing your role. But the idea of that is we're going to have 2 years to transition the relationships and stabilize them so that by the time Joel retires in 2015, these clients, we don't even make an announcement. They've already been transitioned to Joan. Okay? So this has some ramifications though. Let me give you an example. What I'm not saying to somebody is, if you don't give me 2 years notice, you can't leave. What if one of my partners got an offer they couldn't refuse from one of our clients who went public and said, I need you to come in and run the business? I'm going to tell them they can't leave? It's not going to work. So what am I going to do? You didn't give me 2 years notice, you leave. But if we lose any clients during those 2 years, it's going to have a pro rata effect on your buyout. So I'm protecting the firm. I'm not usually lowering the purchase price because no harm, no foul. If I didn't give you notice, I leave and no clients are lost, then why am I being penalized? But if I don't give you proper transition and lose clients, I should take on responsibility for that. And that's where there's an adjustment. Another harsh thing about a retention period is not too many people give you 2 years notice before they die or become disabled. But yet it still has an impact. You see, I teach a class on partnership agreements. Matter of fact, there's one available right here that you can sign on and take. And one of the things I talk about there is you need to protect the firm. If the firm doesn't survive, nobody gets bought out anyway. So for example, let's talk about death and disability. I always try and handle it through insurance. Insurance always isn't the answer. Not everybody's insurable, okay? Sometimes we take out insurance and we find out later that we forgot to update that amount, and someone's retiring at a value of $1 million, but they only have $500,000 of life insurance, and then they get hit by the bus. We have a $500,000 policy, but we still owe $500 grand. So all these things have to be addressed in an internal sale. We use the notification. Now, if someone's got insurance that covers the whole buyout, there's no danger to the firm. If there's a shortfall, then there may be an adjustment in the balance due based on client retention, because the firm must survive. Another reason, by the way, make sure you have the right amount of life insurance so the estate's not in harm's way. When there is a shortfall, one of the other things I tend to do, if there is a strong policy in effect, just a shortfall between what it should have been, is that estate gets that lump sum day one. But that firm might be in trouble. We just lost a partner. We might have to, and nobody loses a partner during the slow season. That unexpected death is when? March 1st. Then when you have to bring in the per diem help on a partner level March 1st, you're paying through the nose, right? So sometimes what I do is I have that first year that money goes to the estate, but the balance gets deferred for a year to give the firm a chance to get back on the feet before they start paying the balance. If the estate just got $500,000, most likely they're okay for that year. The firm may have trouble. You have to talk about your disability policy. and how it's going to impact purchase price in an internal sale. First thing you have to do is define temporary versus permanent disability, but that's again more for the partnership class. But does the disability replace the purchase price? And you might have a penalty buyout for someone, could be the notice, could be retiring because of a loss of license, right? But what's kind of interesting is the new trend in regional firms is when I retire a partner, it's no longer a factor of multiple times their equity interest. It's now, more often than not, a multiple of your compensation. Again, in the partnership agreement class, we'll spend a lot more time on that, but to give you a feel for it, 98 of the top 100 accounting firms no longer pay a partner out based on their equity interest in the firm. They pay them a multiple, usually between 2 and 3 times their average compensation, usually paid out over 8 to 12 year period, in a manner that gives the firm a current deduction, the K1, plus their capital account. Now, I get the questions a lot that say, Joel, how should we value it? You just gave us 5 great bullet points, I hope you think great bullet points, on how to value an external sale. Should we value the internal sale based on the same principles, which certainly can be done and could apply? Should we base it on this new way of a compensation-based versus multiple of compensation instead of equity? I tell them it's a personal decision that you have to make, but I'm going to give you a litmus test to make sure that your buyout makes sense. And here's the premise of it. The premise is that we've all helped our clients make a decision about acquiring a business. How many of you have said to a client, I've done my due diligence, you're going to lose money for the next 5 years, it's a great deal, I definitely think you should buy this business? Nobody. How can we tell our partners then they should make less money when you retire? That's not a motivating factor in succession, okay? If you want to attract young talent into your firm, they should know that when the senior partners retire, they make more money. Or what's their purpose of being there? So here's the litmus test I'm going to provide you that's going to hopefully enable you to apply it to make sure your buyout works. Excuse me. And here's what it is. Let's say I'm a partner at a firm and I'm making $400,000 all in. Let's say we agree to replace my labor is going to cost $100,000. Well, now there's $300,000 left for the firm. How much of that does the retiring partner get? How much of that do the remaining partners get, and for how long? Because based on that concept, the retiring partner is getting paid for their years of sweat equity and the remaining partners are making more money. If your buyout fails that litmus test, your buyout's bad. And when your partners realize it, they might abandon ship on you. There should be plenty of meat on the bone for everybody to prosper. Forgive my cold. This is part of why we're starting to see more and more non-multiple of gross buyouts and more based on compensation, because it's easier to make sure that passes the litmus test. And don't forget, on an internal sale, I am also going to get my capital account. My capital account can be measured in many different ways. Some equity-based firms will say if you're a 20% equity owner, you own 20% of the AR, 20% of the WIP, and 20% of the money in the bloody bank account. Everything's kind of going to be dependent on where your partnership agreement comes out on it. But let's remember, on an internal sale, all 5 variables still apply. But there's these additional considerations that you have to think about. And an external sale is much more of a black and white business transaction, and that's why they usually go for a higher value than an internal sale. A couple things to be wary about on an internal versus an external sale: multiple partners leaving at the same time. It's not a cash issue, because if it passes the litmus test, there's the cash to do it. But if I'm a 6-partner firm and I've got 3 partners all looking to slow down within a year of each other, how are we going to replace that much talent in such a short period of time? I like to have time periods that separate that a little. Be wary of partners that start reducing their time commitment but still make the same money and still in control. It absolutely infuriates your younger partners. Be careful not to get into the mistake of replacing the role, the body, not the role. You can't sit there and say, I got my audit partner retiring and I'm going to promote my tax manager because he's such a good guy and so good. Make sure that when you're thinking about your internal sale, that you have the capacity to replace the people leaving. And make sure your partnership agreements are signed and you're checking it annually to make sure it still makes sense in the modern world of how they're valuing these firms. The last couple things I want to do in our last 15 minutes together or so is to go over some of the things that you need to focus on when performing your due diligence, which we'll spend a little bit of time on. The 4 C's that I alluded to earlier about client retention and choosing the right successor, And the last thing, the keys to transitioning clients and retaining them through any type of succession plan. Let's start with due diligence. When you're doing your due diligence, if you're the successor firm, you want to go in there and get a good history and background of the company. Get an idea of the client retention rates that on both sides. Billings versus collections. Get your arms around the billing rates. Make sure that the compensation package of the firm members that are coming in with the acquisition makes sense. For example, if my seniors are making 90 grand a year and I'm acquiring your firm and your seniors are making 120 grand a year, you really think they're not going to tell each other eventually? So there's some hidden things you got to make sure of, okay? Some of these, look at each other's employee manuals if you have them. Get an idea of what those perks and benefits packages look like. Know whether you need the furniture, fixtures, equipment, or you already have it. What leases are you taking? It may not just be the location lease. It might be a copy lease that you have to take, or a postage meter lease. It could be minor things. Your server lease. Remember, nobody's going to sell you the practice and retain responsibility for certain fixed overhead that they cannot get out of. Look at all these things as part of your due diligence. Who does the work? Where? I'll give you an example of where this is a hidden issue that you really need to focus on. If a partner goes out to the client and does the work there, you can't have a buyer who's now going to have a junior go out to that client, pick up the work, and process it in the office and think that it's not going to impact client retention. Who needs to be visited? What level staff needs to visit them? How are the fees? What industries are served? What services are provided to clients? What services aren't that maybe you could bring to the table? How's their AR? Are they collecting? Is it taking them forever to bring it in-house? The firm culture, we're going to talk about more in a moment. Potential exposure and liability issues. All these things which are on a list that you can easily take a look at are parts of the things you need to focus on when you're doing the due diligence. And hopefully before anybody does any due diligence, you've all signed appropriate non-disclosure agreements, which not only do you need for your clients, but you need for yourself to make sure that that's all properly handled. But let's turn our attention to these 4 C's. A lot of people like when they go to a CPE class to have what they call a takeaway. The first C I suggest to you is your takeaway. It's a word called chemistry. Here's my basic rule of thumb that applies to almost all of the deals that we've done, whether they're a merger or an acquisition, and it's very simple. If you don't want to eat lunch with someone, don't do a deal with them. I cannot tell you how important this most simplistic statement is. Let's understand back to where we started. The whole premise of our dialogue about succession today was, why do you have your clients? It's because of you. Okay? If you're not comfortable with a potential successor, why would you think your clients would be? Why would you think your staff would be? Or your remaining partners, if any, would be? Chemistry is the single most important aspect of any part of the ultimate success of a deal. The next 2 things get tied into each other, and I'm going to skip them for a moment and jump to capacity. We spoke about it a lot already, but I don't think that enough people focus on it. Does the successor firm have the capacity on the appropriate levels to take on the work from the people that will be slowing down, which could include staff? Staff who won't come because we're relocating the office beyond where they're comfortable. Staff who they themselves were looking at an exit strategy. They were looking to slow down or retire. Capacity critical. But let's go back to those middle 2 C's. Continuity and culture. Let's start with culture. Culture has so many definitions. The way clients are serviced, the way the phone is answered. Are we on the cloud? Are we handholders? What level staff? How do we bill? How aggressive are we? Culture could be inside the office for staff. We have casual Fridays. Today I'm not wearing a tie. Your office, everybody has to wear a tie. There are so many components that make up culture. But again, clients have, in most parts of the country, a voluminous amount of accounting firms to choose from. This chemistry, this culture are what attract and retain certain clients. And that brings us to the continuity side of it. And this is going to bring us into the transition phase as well. Continuity. That's what retains clients. If someone's going to have to institute wholesale changes to your practice upon making this deal, there's not going to be that type of continuity, and it's going to have a major impact. So before we really roll up our sleeves and invest our last 10 minutes or so together on the transition phase, let's remember the 4 big C's: chemistry, continuity, culture, and capacity. Let's remember a very important concept. A good deal's a fair deal. No sellers should be Santa Claus and give away what took them years to build. Building a quality practice is an art, a talent, and a lot of time and energy to put into it. Nor will anybody buy your practice to lose money. So we have to make sure that we walk that tight line to make sure everybody's getting something out of it enough to justify the success of the deal. And very importantly, remember it's a package. Stop focusing on an individual variable as every part of the deal. Now, most people have an individual variable that's the most important part of the deal to them. And as long as it's not a crazy individual variable, that could be your starting point. Let me give you an example. We have the 5 variables. Maybe the most important thing to me is I wanted more than one time. Well, maybe in order to get that, I have to give up money up front, give up the tax benefit, have a long payout period, and a long retention period. Maybe the most important thing to me was getting paid out in a short period of time. Then I have to sacrifice the value. I have to do other things. So as long as I remember that each variable impacts the other, it's okay to have one that's the most important. But you have to always remember there's the scales of justice, and Lady Justice is a tough person, okay? So if you're going to move things here, it's going to have to be back to level. So sometimes it's good to put up front your must-haves and your must-thing, but it still has to be a good, fair deal. And let's not forget about the staffs merging. Sometimes in succession planning, we're so focused on the principles, we forget the huge impact it can have on staff and staff's potential relationship in retaining clients. But really, the transition is probably the most telling and most important part of any succession plan. Because how do you really measure the success of your exit strategy? Client retention. If the clients are retained, the seller is going to get paid the maximum value for their practice, the buyer is going to make maximum profit, and these clients have put the seller in a position to be able to retire. There's usually substantial loyalty that we want to do the right thing for them. So let's start with a concept on how we address initially the transition. The key concept starts with the following. It's never the loss of a partner. It's always the gain of the successor firm. So let's start by focusing on that and how we may translate that into a proper succession plan. Let's use the example of an announcement letter tied into the age of specialization. So let's say I'm selling my practice to Jeff. As the seller, I'm going to take my client list and I'm going to break it down into categories. Wholesaler, manufacturer, tax only, doctors, service, etc. And I'm going to basically write one really nice announcement letter, but one paragraph on it or one or two sentences is all I change. So let's say this letter's going out to the doctors. I might say, I'm pleased to announce that I've merged my firm with Jeff. Jeff's an expert in the Obama tax laws and the modern computerization of accounting, and together we'll be able to provide you additional services because of Jeff's expertise and background in the medical community. This is what I mean by the age of specialization. One of the messages I like to do is remembering, for the client's perspective, what's in it for me? Well, if I can bring to you an expert in your industry, that's something in it for us. But before we go further down this road, let's investigate what are the 4 fears that clients may have in a transition. The first one is the person I trust still there? The second one is it going to cost me more money? For some clients who visit their accounting firm, am I going to have to travel? I mean, if you're in the Washington, D.C. area and you have to go the wrong way on the Beltway at the wrong time, 10 miles could be 35, 45 minutes. How that could impact. And for some clients, they may deal with staff almost more, a certain staff member almost more than a partner. Will they be part of it? So let's go back to that announcement letter. How do we handle those 4 fears? Let's go back. I'm pleased to announce I've merged with Jeff. Jeff's an expert in the tax laws, computers, especially as it relates to the medical community. I will still be the partner in charge of you as a client. We're still operating under the same fee structure, but we'll have more services to offer to you. We remain geographically sensibly located here in Manhattan, and the same staff you're used to dealing with are part of our new combined dedicated team of professionals. So in the first paragraph, what did the client see? Person I trust is still there. It's not costing me any more money. They have an expert in my industry. Staff's there, location's there. Why are we going to lose a client? Now, not everybody gets an announcement letter. I don't send an announcement letter out to a $100,000 a year client. I go visit them, but I don't go alone. I remember once having a client tell me about 18 years ago, they went alone to a client, and they said to the client how they just merged with this great firm. They went on, and the client said, Murray, that's great, but you're the partner I deal with. If Murray would have brought with him one of the other partners, that client would have said, nice to meet you, never want to see you again. Murray empowered the client instead of leading the client. So you have to decide who gets a phone call, who gets a visit, when. If I close the practice in July, it's a small firm and there's certain 1040 clients, do I even send the announcement letter out before and give them a year to think about it? Or do I wait till January when I send out the tax organizer and put it in there? Change is a dirty word. Now, to be successful in understanding change, think of change in 2 ways. Change in front of the door, change behind the door. If you were using Lacerte and I use CCH, the client doesn't care. That's a change behind the door. I was charging the client on a retainer basis, and now you switched everything to hourly. A client was dealing with a partner, now they're dealing with a junior. These are changes in front of the door. The emphasis you need to focus on is that of continuity. Not the loss of, but the gain of. And it's the little things. I'll give you an example of a little thing. And until you've done hundreds of deals, you probably don't run into these anal types of things, but here's a great example. I haven't sent out an announcement letter since 1991 that went out in the buyer's envelope. We wrote a beautiful announcement letter and nobody read it. Everybody thought it was a solicitation from another accounting firm. So now when we send out a letter, we send it out in the seller's envelope with the new stationery inside. We make sure the successor firm takes in the phone number. It doesn't answer at Joel Sinkin when they were used to hearing Jane Doe. They answer at accounting office. Or they know it's a dedicated line, and that line they answer. You've reached the offices of Joel Sinkin and Jane Doe. Can we help you? It's the little things you need to think about. So basically what we've tried to share with you today is choosing when to start the process, how to choose a successor, how to value the firm, some things to think about in due diligence, keys to transitioning the client base. On our website, transitionadvisors.com, there's a resource section that has a drop-down that will have articles, case studies. They're all free. We're not sophisticated enough to know you're on it, jump in, take a look. It will give you some great information and some great help. You have any questions, email them in to us, and we'll make sure we get you the answers. I want to thank you all for listening to this New York Nasally Sound for 100 minutes. Have a wonderful day. Thank you.